Welcome back to the channel, everyone. Today I want to talk about whether the shorts can cover and close out of their short positions without pushing the price up and without causing the squeeze. So stay tuned and let's make some money. And I want to dive straight in with the key information. So the question we all want answered is, can the shorts actually close without causing the squeeze? To answer that question, the first question we have to ask is, how exactly do they cover, or how exactly do they close? Now, this isn't a trick question. Obviously, for the shorts to close out of their short positions, they have to buy shares in AMC. But you may say, Tom, do they just have to buy enough shares to close the legal shorts, or do they have to buy the shares to close out the synthetic shorts as well? Now, when the shorts have created legal shorts, they've located shares, they've sold them to open their trade, and later they plan on buying those shares back to close out of the trade. So far, they've sold these shares and therefore they've opened the trade, but they haven't yet closed it, so the trade is still in progress, and they're making unrecognized gains and unrecognized losses. Now, obviously, to recognize those gains or to recognize those losses, they have to buy back those shares to close out the trade. Now, when they've created synthetic shorts, it's a very similar process, but obviously they don't first locate the share. Instead, they create them, but to open the trade, they still sell that created share into the market. The selling of that created share into the market pushes the price down, and that's what they've done billions of times over to create all of these synthetic short positions. Now, they've still shorted this share to open their trade, and therefore the trade is still in progress. They're still taking unrecognized gains and losses, and the trade won't be finished until they buy back the share and close out of their position. And therefore, to fully close their short position to the point where they're not making any unrecognized gains or losses, not only do they have to close out of the legal shorts by buying the shares back, they also have to close out of the synthetic shorts by buying those shares back as well. Now, the only two ways they can effectively finish this trade in AMC is to either A, make sure AMC is relegated from the New York Stock Exchange and from the Nasdaq, so they never have to close out of their short position. And that's very difficult because it involves pushing the price of AMC below $2 per share and holding it there for a consecutive 270 days for AMC to officially be delisted. Now, the other way they finish this AMC trade is by closing out of their short positions and by buying all of these shares back. So now we know that if the shorts want to close out of this position, they have to buy back the shares not just to cover the legal shorts, but also to cover the synthetic shorts as well. Now the question is, can they do this without causing the squeeze? So what does buying back tons and tons of shares do? What does buying back not just hundreds of millions of shares, but buying back billions of shares? Obviously, that's going to push the price up, but it does depend if they're buying shares at the bid or buying shares at the ask. Now, if the retail investors are paper handing and they're panicking and they're selling their shares below the market value by setting a market sell order, then the shorts can buy these shares below the current price, actually pushing the price down further. But by now, us retail investors aren't paper handing, we're setting strategic sell orders above the current market price, and therefore the shorts have to bid the current price up until they reach our shares. And therefore, the shorts buying back hundreds of millions of shares will push the price up because us retail investors aren't panic selling into their buy orders. In fact, they have to push the price up into our strategically placed sell orders. Okay, so we've established if the shorts try and buy back shares to close out of their short positions, it will push the price up. So then what? Can they push the price down faster than they actually push it up when buying back the shares? Can they manipulate the market even more than they currently are and somehow push the price down when they're buying back hundreds of millions of shares, if not billions? And guys, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 10 free stocks worth up to a total of $25,000 and a guaranteed free share of Lucid on top of that. Moomoo is very easy to use, it's incredibly customizable, they've got tons of technical indicators and advanced charting tools. From Moomoo's latest customer agreement, they officially state they do not benefit from your order flow, and they do not sell your order flow to market makers like Citadel or to clearing houses like Apex Clearing. In fact, they clear their trades on their own through their own clearing broker, Futu Incorporated, which does also not sell your order flow, and therefore Moomoo is brilliant for buying those AMC shares. Obviously, for the shorts to push the price down, they need to short more shares, which obviously opens more short positions. They have to create additional FTDs. They have to introduce new swaps, new married and divorced puts, and obviously additional ladder attacks as well. But obviously all this is really doing is creating more short positions to replace their current short positions that they're closing out of. Effectively, they take 2 steps forward and then 2 steps back to exactly the same place. If they close out of 100 million shorts, but they have to reshort 100 million shares to push the price back down, they're effectively net zero because they've closed out of 100 million, but opened 100 million new shorts. Now, obviously, they could replace genuinely shorted synthetic shares with swaps, but ultimately this is still doing the exact same thing because they're still in the same trade. Whether it's a shorted share, a synthetically shorted share, a married and divorced put, or a swap, it's still doing the exact same thing and their trade is still open. Now, I think what you really have to look at in this situation is the volume up versus the volume down. How many shares did it take for us to push the price up, and how many shares did it take for them to push the price down? If we look back to March and we look at the run up to $34 per share, it took 830 million shares to push the price here from $16 per share all the way to the very tippy top at $34. But it then took them over 1 billion shares to push the price back down below this $16 per share mark, and therefore they created a net of maybe 200 million additional synthetic shorts just to push the price back down. And again, back in June of 2021, it was around 3 billion shares to push the price from $14 per share up to $72, but then billions and billions of shares and months, if not an entire year, to push the price back down from $72 all the way back to this $14 region. Now, obviously, we didn't fall below this $14 region until May of 2022, only a few months ago, and therefore it took them practically a full year to push the price back down after the price ran up. And therefore, if the shorts wanted to close out of their position but still push the price back down, it would actually cause them to create more shorts and more synthetic shorts to actually push the price down. And therefore, there's no way that these shorts can actually close out of their short positions without pushing the price up and without causing the squeeze. Even with their manipulation on full, they still have to create more shorts than they're closing to keep the price down. But so why do these shorts try and continually push the price down, and why is AMC falling and hasn't yet squeezed the squeeze? Obviously, hiding these short positions or resetting these FTDs, resetting these swaps and hiding them in the options chain effectively buys the shorts more time. The shorts are obviously hoping and trying to outlast us. They're hoping we get bored and sell our shares so they can cover their shorts without causing the squeeze. If every single retail investor panicked all at the same time and we sold all of our shares, we'd effectively be selling down into their buy orders. This would enable these shorts to buy shares of AMC and cause the price of AMC to fall further and not push the price up. This is effectively the only way these shorts can escape without causing the squeeze, is by outlasting us and forcing all the retail investors to sell our shares into their buy orders. But obviously, as I'm sure we all know by now, retail investors are not panicking. Retail investors are not selling our shares because we know that we've won and we know the squeeze is coming. Obviously, these hedge funds are hoping they survive the crash and they're hoping they can maintain enough margin collateral not to be liquidated and not to force the squeeze. But obviously, it's very, very expensive for these shorts to continue to hold their shorts, to continue hiding their shorts, and to continue resetting the FTDs and resetting the swaps. There's this daily NSCC $3 fee for every single share that fails to deliver, on top of their cost to borrow fees as well, on top of their margin loan fees as well, and every other fee that they're paying. On top of this, it's likely many of these hedge funds won't survive the coming crash. They will be liquidated and it will force the AMC squeeze. And ultimately it costs us, the retail investors, nothing to hold our shares, whereas I just said it's very expensive for these shorts to hold their short positions. And we know this current market crash is just getting closer and closer. As Bitcoin Magazine tweeted, they've said just in. Celsius lawyers claim that users gave up their legal rights to the Bitcoin by using the platform. This effectively means when you buy crypto on a crypto exchange like Coinbase, like BlockFi, like Gemini, or any other crypto exchange out there, you're effectively giving up the legal right to your Bitcoin. Because effectively it's no longer your Bitcoin, it's now their Bitcoin because it's being bought on their exchange. If this is effectively agreed with by the courts, then the exact same thing will go for Coinbase, for Gemini, for Binance, and all of these other crypto exchanges, and they'll effectively be allowed to keep your Bitcoin and your crypto when they eventually go bankrupt. But again, it's not just a case of keeping your crypto, it's also a case of keeping the institutional crypto that has been bought on their platform as well. And again, this is going to cause more and more hedge funds to lose millions, if not billions of dollars, getting closer and closer to that margin call position. And speaking of which, the New York Post is reporting of massive Wall Street layoffs being feared as banking profits tank. It says whispers of hiring freezes and even layoffs have begun to circulate at financial firms as soaring interest rates and recession fears have tanked appetite for mergers, IPOs, and other big corporate deals. An industry luncheon last week with executives from top banks including JP Morgan and Morgan Stanley, chatter was dominated by speculation that layoffs will ravage the industry's workforce by at least 10%. If all of these major banks are having to lay off at least 10% of their workforce, it just goes to show how much these major banks are struggling right now and how close to collapsing they really are. Last month, JP Morgan reportedly began laying off hundreds of bankers in its mortgage division, citing cyclical changes, aka the mortgage market shrinking and potentially the housing market crashing. And interestingly, it's saying that banking sources predict that most higher-ups will remain circumspect at least until summer's end before sharpening their axes. It says because some still hold out hopes the economy could stage a rebound this fall. As such, they aren't keen to shrink their department's budgets mid-year. I think this is a mistake because obviously as the market crash does continue over the next few months, these banks are going to find themselves in an even stickier situation when they react late to the current crash when they should have been reacting earlier. Again, it's just going to cause these banks to take on heavier and heavier losses over the next quarter or over the next 2 quarters as the market crash continues. And again, as I said, this is just going to bring these banks closer and closer to collapse, which would crash the market even further, causing the AMC squeeze. But guys, be sure to let me know what you think down in the comments below. And as always, guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.